But before we get specifically into pensions, I've had an awful lot of questions this week about the impact of the coronavirus on the markets and on the economy. So here's my take on it. The way things stand at the moment, the next logical steps are for a progressive shutdowns of areas affected in an attempt to contain the virus. Yet, as we've seen, largely due to the nature of the virus itself, it hasn't proved possible to prevent its spread. The development of what is now clearly a pandemic is actually also a fascinating reflection of the current international trading patterns. I've just finished reading a book by Peter Frankopan, The New Silk Road, which amongst other things maps out China's key trading relationships. And if you view it from that perspective, perhaps it's a little less surprising that there are numerous cases amongst senior Iranian government officials, for example, and so relatively few cases, until recently at least, in the US. The new cases of the coronavirus are outside China are now exceeding those within as well. And it also appears that the virus, which was originally principally a function of international commerce, has now reached places like sub-Saharan Africa. And one of the reasons sub-Saharan Africa has done so badly in the last decades economically is that its challenges are largely a function of it not being plugged into the globalization miracle that has seen living standards in, say, India and China improve so dramatically over the last 20 or 30 years. The issue is that the disease lacks the sheer dread of Ebola or the historic plagues which at times killed 50% plus of the victims, yet its transmission is similar to the common cold, and with the added twist that the carriers are contagious long before they present with symptoms. And in any case, many of the people who suffer from the disease or catch the disease won't even be aware of it because their symptoms are so mild. What the markets have been discounting is far less the impact of the disease itself as the measures to attempt to contain it. That is possibly one explanation for why investors took so incredibly long to react to the crisis. It's only really been this week that markets have suddenly switched on to the fact that basically supply chains and commerce are grinding to a halt right the way across the world. And the situation we've got is that it's highly unusual for companies to have already warned about these things, about the logistical problems they were having. Say, for example, Apple warned that it was going to have supply difficulties from China in supplying iPhones and what have you several weeks ago, yet its stock and the S&P 500 and our own local FTSE market were still doing exceptionally well until as recently as last Friday. And that's what's sort of a bit strange about it, because usually what happens is markets panic first and then kind of start to stabilise once they've got some numbers to play with. So they think there's something to really worry about, then they get some numbers which puts it in perspective and they calm down. Whereas this time around, precisely the opposite has happened. We've known what to worry about, but the markets have been oblivious to that and have not actually sort of really got to grips with what's going on until this week. And indeed, humans in general are extremely poor judges of risk and probability. We'll happily buy lottery tickets, for example, oblivious to the fact that the act of buying a ticket only ever so slightly increases our chance of winning it than not having one at all. But at the same time, we'll still happily march into the traffic in front of a bus yammering away on our phones, which is a lot more likely to end badly than buying a lottery ticket is likely to end well. So going forward, the problem is that, just like the disease itself, the economic fallout is immune to current monetary measures. And this is the important bit. So cutting interest rates is very unlikely to help. High asset prices, the strength of the stock market and rising house prices, have largely been justified by the belief that central banks will always be able to ride to the rescue. Yet here we are with an economic malady which central bankers are powerless to remedy, and everyone can quite clearly see that that's the case. So the point was underlined, if you like, today when the ECB president, Christine Lagarde, told the Financial Times that policymakers are monitoring the situation very carefully, but they don't judge that the outbreak will have a lasting impact on inflation. And you think, what? Inflation is so not the point right now, although ironically down the line it might well have an impact on inflation. But what's being alluded to there is the impotence of central bankers and policymakers to actually be able to do anything to ease the economic pain that is being caused by the measures to try and contain the virus. The issue is that products such as the ubiquitous iPhone, we've already mentioned that, involve 43 countries and based on 6 different continents, and that's even without getting into the raw materials that make up the metals and plastics that make the individual components. So we live in a very, very joined up world, and I've already heard examples from friends and colleagues this week of entire production lines shutting down because a single very cheap, inexpensive part but sourced from an inconvenient part of the world at the moment is unavailable, and that's where the issue comes from. And cutting interest rates isn't going to make that part available, although it might make the temporary hiccup in business slightly more survivable. So that when you get countries like Japan announcing that they're going to be closing all their schools from Monday, and I guess many businesses will follow suit, then that's a really big deal. And equally, companies will want to be seen as good citizens, and they'll want to be scrupulous in attempting to avoid being labelled a super spreader, as happened to that poor guy Steve Walsh after he returned from a conference in Singapore last month. The last thing, say, a dairy producer, for example, would want is a photo going viral of its chief executive sneezing into a huge vat of butter. So what's the outlook? At some point or other, we're going to have to shift to a more risk-based mitigation approach to the disease rather than attempting to shut everything down and collapsing the economy in the process. Much will depend on how the current return to work in China goes, for example. That will be the model going forward. If China manages to keep new cases in check whilst normalising activity, then that will be the best outcome for everyone. And finally, one encouraging aspect about the spread is that men appear to be disproportionately affected. Now, this isn't simply a crude attempt to curry favour or curry gender favour on my part ahead of International Women's Day next month. It's more a point that men are famously less, how shall we put it, fastidious with their hygiene than women. The fact that men appear to be disproportionately vulnerable to the virus does rather suggest that simple hand washing and sanitising are effective countermeasures. So let's just keep our fingers crossed that the whole thing runs its course sooner rather than later, aided by rigorous hygiene, and that we can get back to life as normal as soon as possible.